There's a question that orbits Warren Buffett like a persistent moon. A question asked in 1,000 different ways, in interviews, at shareholder meetings, and in financial articles for over 30 years. Why don't you invest in technology? For decades, as the world was being rewritten in silicon and code, the Oracle of Omaha seemed content with insurance, railroads, and Coca-Cola. The common answer, the one you've probably heard, is that he's an old man, set in his ways, a technological dinosaur who simply doesn't get it. It's a simple, convenient narrative, and it is completely, utterly wrong. The truth is far more profound and infinitely more profitable. Buffett's famous aversion to most tech stocks has nothing to do with a fear of the future or an inability to understand a microchip. It stems from a single foundational principle, a mental model so powerful that it has protected him from the single greatest cause of permanent capital loss for the average investor: speculation. He doesn't see himself as a stock picker, he is a business buyer. And that simple shift in perspective, from a trader of flickering symbols on a screen to a partial owner of a real enterprise, changes everything. It's the difference between gambling on the weather and owning the farm. One is a game of chance, the other a long-term enterprise of sowing and reaping. Most investors, especially in the exciting, story-driven world of tech and growth stocks, are weather bettors. They are in-and-outers, chasing storms of hype and fleeing the first signs of a drought. Buffett is a farmer. He is looking for fertile soil, a predictable climate, and a strong fence to keep the wolves out. He's not trying to guess the price of wheat next week. He's trying to buy the most productive acre of land he can find and hold it for a lifetime. This is the great secret. This is the financial transformation we are about to explore. We are going to deconstruct this business owner mindset into its core components, revealing not just what Buffett does, but why it works on a deep, psychological level. You will learn to separate the durable, inevitable businesses from the speculative flashes in the pan. You will understand why a boring candy company can be a far better investment than a revolutionary software giant. By the end of this journey, you won't just look at stocks differently. You will have acquired a new framework for making major financial decisions, a blueprint for true wealth building, and a permanent defense against the most costly mistakes that plague 99% of market participants. The first pillar, the very bedrock of this entire philosophy, is the fundamental shift in identity. You are not a stock trader, you are not a speculator, you are not playing the market. From this moment forward, you are a silent partner in a series of businesses. You are a capital allocator. You are buying a piece of an actual company, with buildings, and employees, and customers, and cash flow. This isn't just a semantic game. It's a complete reframing that alters every subsequent decision you make. To understand its power, we have to travel back to 1972. Warren Buffett and his partner, Charlie Munger, were presented with an opportunity. It wasn't a hot new electronics company or a promising biotech firm. It was a box of chocolates. The company was See's Candies, a beloved West Coast confectioner. The asking price was $30 million. Buffett and his friend Rick Guerin took a look at the numbers. The business had about $8 million in tangible assets, things like stores and equipment. It was earning about $2 million a year after taxes. From a traditional value investing perspective, the kind Buffett had learned from his mentor Benjamin Graham, the price was outrageous. Graham taught him to buy businesses for less than their liquidation value, to buy cigar butts with one good puff left in them for free. And here was a business asking for a price almost 4 times its physical worth. Buffett's instinct, honed by years of this cigar butt approach, was to walk away. The price was too high. It was a classic asset-based valuation. But Charlie Munger, in a moment that would forever alter the course of investment history, said something that changed Buffett's mind. He told him, "You're thinking about this all wrong." He argued that they weren't just buying $8 million of assets, they were buying an incredible brand. They were buying a place in the customer's mind. For 50 years, people on the West Coast had been giving See's Candies on Valentine's Day. They had been bringing a box to family gatherings at Christmas. The act of giving C's was associated with love, family, and tradition. That mental association, that brand loyalty, was an asset too, an intangible one, but an asset nonetheless. It allowed C's to raise its prices by 10% every year without losing customers. People weren't just buying chocolate. They were buying a feeling, a memory, a guarantee of quality. This was an economic franchise. Munger convinced Buffett to look past the physical assets on the balance sheet and to evaluate C's as a complete business. What was its position in the marketplace? How did customers feel about it? Could it consistently raise prices? They ended up negotiating the price down to $25 million, which was still a hefty premium over its tangible assets. Buffett later admitted he was still nervous. He was paying for something he couldn't see or touch, the power of the brand. That $25 million investment has since generated over $2 billion in pre-tax earnings for Berkshire Hathaway, money that was then redeployed to buy other great businesses. It required almost no additional capital investment. C's became the prototype, the foundational model for a new kind of investing. It was the moment Buffett fully transitioned from being a buyer of cheap stocks to a buyer of wonderful businesses. He wasn't looking at a ticker symbol, SEE, and its price-to-book ratio. He was looking at the entire operation, the sticky floors in the stores, the smiling faces of the employees, the loyalty of the customers who would drive across town to get that specific box of chocolates. He bought the business, not the stock. The psychological principle that makes this shift so powerful is a deep-seated cognitive bias known as the framing effect. The way a choice is presented to us, or framed, has a massive impact on the decision we make, even if the underlying facts are identical. If I tell you a medical procedure has a 90% survival rate, you'll likely feel good about it. If I tell you the exact same procedure has a 10% mortality rate, your emotional reaction will be one of fear and hesitation. The data is the same, but the frame changes everything. The investing world is a masterclass in framing. When you see a stock on a screen, it is framed as a number, a ticker symbol, next to a price that is constantly changing, usually colored red or green. This frame encourages a specific set of behaviors. It primes you for action. It makes you feel that the price itself is the most important piece of information. It reduces a complex, living, breathing enterprise into a single volatile data point. This is the in and outer frame. Your brain is naturally drawn into a game of, will the number go up or down? You suffer from what behavioral economists call myopic loss aversion. Because you're watching the price tick by tick, every small dip feels like a painful loss. Your brain's threat detection system, the amygdala, fires up. You feel an urgent need to sell, to make the pain stop. Conversely, when the price goes up, you get a hit of dopamine, the reward chemical. You're tempted to sell, to lock in the gain, to feel the thrill of victory. This entire emotional roller coaster is a product of the frame. Now consider the business owner frame. You don't see a ticker. You see your share of a candy company. You own a piece of the stores, the brand, the earnings power. You've reframed the investment. When the stock market has a bad day and the price of your holding drops by 3%, do you panic? A business owner doesn't. Did your candy company burn down yesterday? Did its customers suddenly decide they hate chocolate? No. The underlying business is unchanged. The market is just having one of its temporary fits of pessimism. The lower price, in this frame, isn't a threat. It's an opportunity. It's your other partners in the business offering to sell you their stake at a discount. A business owner thinks in terms of years and decades, not minutes and hours. They are focused on the operational performance of the company. Are sales growing? Are profit margins healthy? Is management doing a good job? By shifting your perspective from speculator to owner, you sidestep the entire psychological trap of myopic loss aversion. You activate a different part of your brain, the prefrontal cortex, which is responsible for long-term planning and rational decision-making. You also benefit from the endowment effect, another powerful cognitive bias. We inherently value things more highly simply because we own them. When you think of yourself as a part owner of Apple or Coca-Cola, you treat it with more care and attention. You are less likely to trade it away on a whim. It's not just a line item in a brokerage account, it's asterisk your company. This mindset is a psychological fortress against the madness of the market. So how do you, as an individual investor, actually apply this? How do you build this fortress for yourself? It starts with a practical, step-by-step mental model I call the business owner's litmus test. This is a process you must go through before you ever click the buy button. First, you must consciously and deliberately ignore the stock chart. Do not look at the 1-day, 3-month, or 1-year price history. It is irrelevant noise designed to trigger your emotional biases. Instead, go to the company's investor relations website and download the last 10 annual reports. Yes, 10. You are buying a business for the long term. You need to understand its history. Second, you will ask yourself the single most important question in this entire process. If I had the total market capitalization of this company in cash, and it were a private business for sale down the street, would I buy the entire thing? Let's take an example. If a company's market cap is $50 billion, you must ask, would I write a check for $50 billion to own this whole enterprise, lock, stock, and barrel? This question forces a profound shift in seriousness. You are no longer gambling a few $1,000s. You are contemplating a monumental capital allocation decision. Third, you must analyze it exactly like a private buyer would. Read the CEO's letters to shareholders in those annual reports. Is this a management team you would trust to run your business? Look at the cash flows. Is this business consistently generating more cash than it consumes? Who are the customers? Are they loyal? What is the competitive landscape? Could a new competitor easily come in and steal your market share? You are performing due diligence, not just looking at a price-to-earnings ratio. Fourth, after your research, you must be able to write down, in a single, simple paragraph, exactly how this business makes money. If you have to use a lot of jargon or complex terms, you don't understand it well enough. For See's Candies, you might write, See's sells premium chocolates through its own retail stores, primarily on the West Coast. Its strong brand, built over decades, allows it to command high prices and fosters intense customer loyalty, especially around holidays, generating significant and predictable cash flow. Simple. Clear. If you can't do that for a tech stock or any other company, you have no business owning it. Finally, you must hold yourself to the ultimate standard of conviction. Ask yourself, would I be comfortable if this single investment was the only asset my family owned for the next 10 years? If the answer is anything less than an enthusiastic yes, then you have not yet adopted the business owner mindset. You are still thinking like a speculator, hoping for a quick gain rather than investing in a durable enterprise. This litmus test is a filter. It will cause you to reject 99% of the investment ideas that come your way, and that is precisely the point. It forces you to concentrate your time, energy, and capital on only the most exceptional opportunities, the true A-plus businesses that you understand deeply and trust implicitly. To truly appreciate the power of this approach, we must spend some time examining its opposite, the path walked by 99% of investors. I call it the ticker symbol fetish. For most people, the stock market is not a collection of individual businesses. It's a singular entity, the Dow, or the Nasdaq, a giant, abstract casino. Their engagement with it is through the ticker symbol. They don't talk about owning a piece of a world-class software company. They say they are in Microsoft or long Apple. They see a ticker like TSLA, and it doesn't represent a car company with factories and supply chains. It represents a squiggly line that they hope goes up. This mindset is a recipe for financial disaster, and it's fueled by a financial media ecosystem that thrives on action and excitement. The constant ticker tape running across the bottom of the screen, the market alert graphics, the breathless reports on minute-by-minute price swings, all of it is designed to reinforce the frame of the stock as an object of speculation. People caught in this fetish become obsessed with things that have nothing to do with business value. They get into technical analysis, trying to find predictive patterns in the random squiggles of a chart, a modern form of astrology. They talk about resistance levels and moving averages, as if these lines drawn on a graph have some mystical power over the future earnings of a corporation. The consequences are predictable. Because they are focused on price, not value, they are psychologically primed to do the exact wrong thing at the exact wrong time. When the market is euphoric and prices are high, they are overwhelmed by a fear of missing out, or FOMO. They see their neighbor getting rich on some hot growth stock, and they pile in at the top, buying with no understanding of the underlying business, only a desire for the price to keep rising. Then, when the inevitable correction comes, when the market panics and prices fall, their only reference point, the price, is flashing red. The fear of further loss becomes unbearable. They sell at the bottom, crystallizing their losses. They buy high and sell low, the cardinal sin of investing, over and over again. This is especially prevalent with tech stocks, where the narrative is so compelling and the underlying business is often so complex. An investor might buy a semiconductor stock not because they've read the 10K and understand its fabrication process, but because they heard a pundit say AI is the future. Their entire investment thesis is a three-word slogan. The ticker symbol fetish turns investing from a disciplined, long-term enterprise into a stressful, emotional, and ultimately wealth-destroying hobby. The financial implications of choosing the business owner mindset over the ticker symbol fetish are not small. They are staggering, life-altering, and they compound over time into a chasm of difference in your final net worth. The first and most obvious connection is in the drastic reduction of friction costs. An in-and-outer who is constantly trading is a whirlwind of activity, and every action has a cost. There are transaction fees, though smaller now, they still add up. More insidiously, there is the bid-ask spread, the small slice you lose to the market maker on every single trade, buying and selling. But the real monster is taxes. In the United States, if you hold an asset for less than a year, any gain is considered a short-term capital gain and is taxed at your ordinary income tax rate, which can be as high as 37%. If you hold it for more than a year, it's a long-term capital gain, taxed at a much more favorable rate of 15% or 20% for most people. Let's imagine two investors. Investor A, the in-and-outer, makes a series of great trades, earning 15% on his portfolio for the year. Investor B, the business owner, also has her portfolio of businesses appreciate by 15%, but she doesn't sell anything. Investor A loses, say, 35% of his gain to short-term capital gains taxes, so his real return is only 9.75%. Investor B's return is the full 15%, which stays in her portfolio to compound for the next year. Over a 30-year period, this difference alone can amount to hundreds of thousands if not millions of dollars. The business owner's portfolio grows from a larger base every single year. But the most significant financial advantage is the avoidance of catastrophic behavioral errors. The Dalbar QAIB report is a famous annual study that compares the returns of the average equity mutual fund investor to the return of the S&P 500 index. Year after year, the average investor dramatically underperforms the market. It's not because their funds are bad, it's because they jump in and out of them at the worst possible times. They chase performance, pouring money in after a period of high returns, and then pull it out in a panic after a market drop. The business owner, by focusing on the underlying enterprise and not the daily price, is insulated from this self-destructive behavior. Their portfolio strategy is one of extreme patience, punctuated by rare moments of decisive action when a wonderful business goes on sale. This leads to a portfolio that is often more concentrated in a few high-conviction ideas, because they've done the deep work required by the business owner's litmus test. This concentration and excellence, combined with low turnover and tax efficiency, is a powerful engine for long-term wealth building. It is how you move from gambling on tickers to building real, generational wealth. This leads us directly to the second great pillar of Buffett's philosophy, the one that directly answers the question of why he so famously avoided tech stocks for most of his career. It's a concept he calls the circle of competence. This isn't just a quaint saying, it's a ruthless operational mandate that dictates where he will and will not allocate capital. The principle is brutally simple. You must have a deep, practical understanding of how a business works and, crucially, a high degree of confidence in your ability to forecast its competitive position 10 to 20 years into the future. If you cannot do that, you are forbidden from investing. It's not about being a genius in every industry. It's about knowing the precise boundaries of your own knowledge and never, ever stepping outside of them. The greatest illustration of this principle in action was not an investment Buffett made, but the thousands of investments he refused to make during the greatest speculative mania of the 20th century, the dot-com bubble. From 1995 to early 2000, the world went wild for the internet. Any company with a .com at the end of its name saw its stock price soar to unimaginable heights, often with no revenue, let alone profits. Companies like Pets.com and Webvan were hailed as the future, valued in the billions. Meanwhile, Warren Buffett and Berkshire Hathaway were being openly ridiculed. Barron's magazine ran a cover story in 1999 titled, "What's Wrong, Warren?" His portfolio, filled with old economy stocks like Coca-Cola and Gillette, was dramatically underperforming the Nasdaq. He was called a dinosaur, a relic, a man who had lost his touch. The pressure to join the party must have been immense. His shareholders were watching their neighbors get rich on tech stocks, while Berkshire's stock stagnated. In his 1999 letter to shareholders, Buffett addressed the criticism head-on. He didn't get defensive. He didn't pretend to understand the new paradigm. Instead, he wrote with stunning intellectual humility. He explained that he and Charlie Munger simply did not know how to value these new internet companies. They couldn't, with any certainty, picture what the competitive landscape for online pet food delivery or online grocery shopping would look like in 10 years. Would there be one winner? A dozen? Would any of them ever be profitable? He wrote, "The key to investing is not assessing how much an industry is going to affect society or how much it will grow, but rather determining the competitive advantage of any given company, and above all, the durability of that advantage. The products or services that have wide, sustainable moats around them are the ones that deliver rewards to investors." He admitted that the internet would change the world, but that knowing that fact did not tell you which companies would be the long-term winners. He was defining the edge of his circle of competence, and he was refusing to step over it, no matter the social or professional cost. And then, in March of 2000, the bubble burst. The Nasdaq, which had peaked above 5,000, collapsed by nearly 80% over the next 2 years. Those high-flying dot-com darlings went to zero. Fortunes were wiped out overnight. And Warren Buffett, the dinosaur, looked like a prophet. He hadn't predicted the crash. He had simply followed his discipline. He stayed within his circle, a circle defined not by industry, but by the simple, powerful standard of predictability. The psychological force that Buffett was battling, both in the market and within himself, is one of the most well-documented and dangerous cognitive biases, the Dunning-Kruger effect. This is the phenomenon where people with low ability in a specific domain tend to dramatically overestimate their competence. In short, they are too ignorant to recognize their own ignorance. The dot-com bubble was a nationwide case of the Dunning-Kruger effect. People who had just learned how to use a web browser suddenly believed they were experts in valuing complex technology businesses. They heard a few buzzwords like B2B e-commerce or network effects, and their confidence soared. This is a crucial trap for anyone looking at growth stocks. The excitement and novelty of a new technology create an illusion of understanding. The opposite side of the Dunning-Kruger effect is that true experts are often acutely aware of the limits of their knowledge. They know how complex their field is, so they tend to be more humble about their own abilities. This is Buffett. His decades of analyzing businesses taught him just how hard it is to predict the future. His humility wasn't a personality quirk, it was an earned intellectual position. He knows what he doesn't know, and that is his superpower. He actively combats the overconfidence bias, the natural human tendency to be too sure of our own judgments. By defining a strict circle of competence, he creates a system, a set of rules, that prevent his own ego or emotions from leading him into areas where he is a novice. He understands that in investing, the mistakes you don't make are just as important as the brilliant moves you do make. Avoiding the big, catastrophic error is often more important for long-term wealth building than hitting a speculative home run. The circle of competence is a behavioral defense mechanism. It's a pre-commitment to intellectual honesty. It forces you to say the 3 hardest words for any intelligent person to admit: I don't know. In a world that rewards confident-sounding predictions, this quiet humility is the most radical and profitable stance you can take. So how do you define your own circle of competence? This isn't an abstract exercise. It is a practical and essential step in becoming a serious investor. I want you to perform a mental model exercise called mapping your circle. Take out a blank piece of paper. You're going to divide it into 3 columns. Label the first column, expert, the second, familiar, and the third, ignorant. Now be brutally honest with yourself. In the expert column, you are only allowed to list industries or business types where you have a deep, almost professional level of understanding. Perhaps you've worked in the banking industry for 15 years. You understand financial regulation, credit cycles, and how banks make money on a granular level. Banking goes in your expert column. Maybe you're a software developer. Certain types of enterprise software might go in this column. Or perhaps you have a lifelong obsessive hobby. If you've been a passionate gamer for 20 years, you might have a true expert-level understanding of the video game industry's competitive dynamics. This column should be very, very short. This is your core circle, your hunting ground. Next, the familiar column. Here, you can list industries that you understand well as an intelligent consumer. You might not know how Coca-Cola's bottling and distribution system works in detail, but you understand the power of their brand. You use a bank, you have insurance, you shop at Costco. These are businesses whose models are relatively straightforward and where you have some direct user-level experience. This column can be a bit longer, but it's your secondary circle. Any investment here will require significant extra research to move your understanding closer to the expert level. Finally, the ignorant column. This is the most important column on the page. In here, you will list everything else. Complex biotechnology, deep-sea oil exploration, semiconductor manufacturing, emerging market microfinance. Unless it's your direct profession, be quick to place industries in this column. The default assumption should be ignorance. Now here is the rule for applying this map to your investment philosophy. 90% of your research time and all of your investment capital should be dedicated to the companies within your expert column. The other 10% of your research time can be spent on the familiar column, with the explicit goal of trying to learn enough to move a company into your core circle. You are forbidden, absolutely forbidden, from ever investing in a company that falls in the ignorant column. No matter how exciting the story, no matter how much a friend or a TV pundit recommends it, you must treat that column as a radioactive zone. This simple exercise provides a powerful visual filter for your decision-making. It's a personalized system for risk management, ensuring you are always playing on a field where you have an edge, however small. The antithesis to this disciplined approach is what I call the narrative trap, and it is the primary reason why most people lose money on exciting growth stocks. The human brain is not a computer that processes data, it's a story machine. We are wired to respond to and remember compelling narratives far more than we are to spreadsheets of financial data. And the world of tech stocks is built on the most seductive narratives of our time, stories of disruption, of changing the world, of visionary founders. These stories are powerful, and they are dangerous. The narrative trap is the act of falling in love with the story of a company and mistaking that story for a good investment. You hear about a company that's using artificial intelligence to cure diseases. That's a phenomenal story. It's inspiring. And you invest. But you haven't invested in a business. You've invested in a narrative. You don't know if their technology actually works, if they have a viable path to market, if they can get regulatory approval, if they can ever be profitable. You've simply bought a ticket to a feel-good story. The dot-com bubble was the ultimate example of the narrative trap. The story was, the internet changes everything. And it was true. But that macro narrative said nothing about whether Pets.com specifically was a viable business. People conflated the two. They confused a technological paradigm shift with a sound capital allocation decision. Today, we see the same thing with buzzwords like blockchain, metaverse, or quantum computing. A company attaches itself to one of these grand narratives, and investors flock to it, often without any real understanding of the company's specific business model or competitive position. They're not investing, they're buying a lottery ticket on a popular theme. How do you know if you're in the narrative trap? Ask yourself this. If you had to explain your investment thesis, do you talk more about the company's story and its potential to change the world? Or do you talk about its return on invested capital, its profit margins, and its specific, durable competitive advantage? If you're talking about the former, you're likely caught in the trap. Buffett's circle of competence is the antidote to this. It forces you to move past the exciting story and grapple with the boring but essential questions of business fundamentals and long-term predictability. It's the discipline of being a financial analyst, not a science fiction fan. The direct financial connection between adhering to a circle of competence and your portfolio's performance is profound, and it centers on one of the most important concepts in all of finance: the avoidance of permanent capital loss. Investing is a game of compounding, and the math of compounding is unforgiving when it comes to losses. If you lose 50% of your capital on a speculative bet outside your circle of competence, you don't need to make 50% to get back to even. You need to make a 100% return just to get back to where you started. A single large loss can set you back for years, wiping out the gains from many successful investments. The circle of competence is your primary defense against these zeros. By only investing in businesses you understand deeply, you dramatically reduce the probability of being completely blindsided. You understand the key risks. You know what metrics to watch. You're less likely to invest in a business that is fundamentally flawed, or, even worse, a fraud. Your portfolio strategy shifts from a home run mentality to a don't strike out mentality. Over a long investment career, it is the investor who avoids the big mistakes who often ends up with the most wealth, not the one who has a few spectacular high-risk wins. Furthermore, operating within your circle allows for a more effective market analysis. You have an informational or analytical edge. When the market panics about your industry, you have the deep knowledge to determine if the fear is justified or if it's an opportunity. During the dot-com bust, investors who were true software experts, not just speculators, were able to pick up shares in great companies like Microsoft or Adobe at bargain prices, while the narrative chasers were wiped out. Your circle gives you the conviction to act when others are paralyzed by fear. This translates into a portfolio with a much higher probability of steady, tax-efficient, long-term compounding. It might not be as exciting as gambling on the next hot tech stock, but it's a far more reliable path to genuine financial freedom. It is the professional's approach to risk management, and it is available to anyone willing to embrace the simple power of intellectual humility. Once you've adopted the mindset of a business owner and defined the boundaries of your circle of competence, you need a way to identify the truly exceptional businesses within that circle. This brings us to the third pillar, the very heart of Buffett's long-term investment philosophy, the concept of the economic moat. A moat, in medieval times, was a deep, broad ditch filled with water surrounding a castle, designed to protect it from attack. In business, an economic moat is a durable competitive advantage that protects a company from competitors, allowing it to earn high returns on capital for a very long period of time. Buying a business without a moat, no matter how fast it's growing, is like buying a castle built on an open plain. It may look impressive for a while, but sooner or later, the barbarians will arrive. The story that best illustrates Buffett's genius for identifying a powerful, non-obvious moat is his investment in American Express in the fall of 1963. The company was facing a crisis that threatened its very existence. A division of American Express, which warehoused goods and issued receipts against them, was caught in a massive scandal. One of their biggest clients, the Allied Crude Vegetable Oil Company, had perpetrated a huge fraud. They had filled their giant storage tanks mostly with water, with a thin layer of salad oil on top. They then borrowed huge sums of money against the warehouse receipts for this non-existent oil. When the fraud was discovered, Allied went bankrupt, and American Express, which had guaranteed the receipts, was on the hook for what amounted to over $175 million in today's money. The market panicked. Wall Street assumed the scandal would destroy American Express. The stock price was cut in half. Everyone was selling. It was a moment of peak fear. But Buffett, a young, little-known fund manager from Omaha, saw things differently. He knew this was a business that fell within his circle of competence. He understood the basics of finance and insurance. So he did what a business owner would do. He investigated. He didn't just look at the stock chart. He went out and did his own primary research. He went to restaurants and travel agencies. He talked to merchants. He talked to their competitors. And he discovered something crucial. The scandal was contained to the warehousing division. The core businesses, the traveler's checks and the American Express charge card, were completely unaffected. In fact, he saw customers still lining up to buy the traveler's checks, and merchants were still proudly displaying the American Express card's welcome sign. He realized that American Express's true asset wasn't its balance sheet. It was the trust that its brand commanded in the minds of millions of consumers and merchants. This brand, this psychological association with safety and prestige, was a powerful, intangible economic moat. Competitors could offer a similar piece of plastic, but they couldn't replicate the decades of trust built into the American Express name. Convinced that the market was confusing a temporary, solvable problem in one division with a mortal wound to the entire enterprise, Buffett acted decisively. He invested 40% of his entire partnership's capital into American Express stock. It was an incredibly concentrated, high-conviction bet. Over the next few years, as the company moved past the scandal and its powerful moat reasserted itself, the stock price soared. The investment was a massive home run and helped cement his early reputation. This story is the perfect lesson in moats. Buffett looked past the terrifying headlines and the panicked selling to identify a deep, durable competitive advantage that the rest of the market was completely blind to. The psychological biases at play during the salad oil scandal are the same ones that cause investors to misjudge companies today. The primary culprit is confirmation bias, our tendency to search for, interpret, and recall information in a way that confirms our pre-existing beliefs. When the news of the scandal broke, the prevailing belief or narrative was, American Express is in deep trouble. Investors then sought out any piece of information that confirmed this view. They focused on the potential losses, the lawsuits, the negative headlines. They ignored or downplayed any disconfirming evidence, like the continued strength of the core card business. Buffett, by contrast, actively sought out disconfirming evidence. He went looking for reasons why the Amex's doomed thesis might be wrong. This is a critical discipline for any serious capital allocator. You must constantly try to kill your own best ideas. The second bias is social proof or herding. When we are uncertain, we tend to look to the actions of others to guide our own behavior. In 1963, every smart investor on Wall Street was selling American Express. The social proof was overwhelming. To buy in that environment required immense psychological fortitude and an independence of thought that is exceptionally rare. Moats are often overlooked precisely because they are frequently boring and intangible. A powerful brand, high switching costs, or a low-cost production process are not as exciting as a disruptive new technology. They don't make for breathless headlines. Therefore, the market often underappreciates their value, especially during times of crisis. Buffett's entire career is a testament to the financial power of being rational when others are emotional, and his framework for identifying economic moats is a system for achieving that rationality. It allows him to tune out the noise of social proof and confirmation bias and focus on the fundamental, long-term reality of a business's competitive position. So how do you systematically identify and analyze these moats for yourself? You need a practical framework. There are 5 primary types of economic moats that you should be looking for. Think of this as your moat identification checklist when you are performing your business analysis. The first, and perhaps most famous, is intangible assets. This includes things like brands, patents, and regulatory licenses. A brand is a moat when it allows a company to charge more for a product that is functionally identical to a competitor's. Coca-Cola is the classic example. People will pay a premium for a Coke over a generic store-brand cola, even if they can't tell the difference in a blind taste test. That is pure brand power. See's Candies is another perfect example. Patents can create a temporary monopoly for pharmaceutical companies, and regulatory licenses like those required to operate a railroad or a credit rating agency like Moody's can be extremely powerful barriers to entry. The second type of moat is switching costs. This exists when it is expensive, time-consuming, or just plain annoying for a customer to switch from your product to a competitor's. Think about your bank. Switching your checking account is a massive hassle. You have to redirect your direct deposit, change all your automatic bill payments. The switching cost is high, so you stay, even if another bank offers a slightly better interest rate. Enterprise software is another classic example. Once a company has trained thousands of employees on Microsoft Office, the cost and disruption of switching to a different suite are enormous. This is the moat that eventually brought Buffett around to investing in Apple. The stickiness of the iOS ecosystem creates incredibly high switching costs for its users. The third moat is the network effect. This is a powerful phenomenon where a product or service becomes more valuable as more people use it. The telephone was the first great example. A single telephone is useless, but a network of millions is world-changing. Modern examples include credit card networks like Visa and MasterCard. The more merchants that accept Visa, the more useful it is for consumers to have a Visa card, and the more consumers that have a Visa card, the more essential it is for merchants to accept it. This creates a virtuous cycle that is incredibly difficult for a new competitor to break into. Social networks and online marketplaces also benefit from this powerful moat. Fourth, we have cost advantages. This is when a company can produce and deliver its products or services at a consistently lower cost than its rivals. This can come from superior processes, better scale, or a unique geographic advantage. Geico, one of Buffett's best investments, has a huge cost advantage because of its direct-to-consumer model, which allows it to bypass the expensive agent network that its competitors rely on. Walmart's massive scale gives it tremendous bargaining power with suppliers, allowing it to offer lower prices than smaller retailers. Finally, there's a fifth, more subtle type that Munger calls a Lollapalooza effect, where multiple moats work together to create an almost impenetrable fortress. Think of a company like Google, which has the brand moat of being the default verb for search, the network effect of its user data making its search results better, and massive cost advantages from its incredible scale. When you analyze a company, you must go through this checklist and ask, does this business have one or more of these moats? And, even more importantly, is that moat getting wider or narrower over time? A business with a widening moat is a true compounding machine. The path of the 99%, the antithesis of this deep analysis, is to make one of the most common and costly mistakes in modern investing: confusing growth with a moat. In the world of tech and growth stocks, investors are mesmerized by revenue growth. They see a company whose sales are increasing at 50% or 100% per year, and they automatically assume it must be a great business with a strong competitive position. This is a dangerous fallacy. Growth by itself is not a moat. In fact, unprofitable growth can destroy value. Many competitive tech sectors are flooded with venture capital money. Companies use this cash to subsidize growth, spending massively on marketing and promotions to acquire new customers. They might offer a service for a price that is far below its actual cost, all in the name of, quote, capturing market share. A great example was the meal kit industry. Companies like Blue Apron showed spectacular revenue growth. Investors got excited and poured money into the stock. But where was the moat? There were no real switching costs. A customer could try Blue Apron one week and a competitor the next with zero friction. There was no brand loyalty that commanded a premium price. There were no cost advantages. In fact, the logistics of shipping individual boxes of fresh food were incredibly expensive. The result? As soon as the marketing dollars were scaled back, the growth vanished. Competitors swarmed the market, and the stocks collapsed. The same story has played out in countless other growth industries, from ride-sharing to e-scooters. The companies burn billions of dollars to attract customers, but they have no durable advantage to keep them. This is blitzscaling without a moat, and it's a recipe for shareholder pain. A true investor must be a skeptic. When you see high growth, your first question shouldn't be how high can it go. It should be, is this profitable growth, and what is the moat that will protect those profits in the future? If you can't find a convincing answer, you must walk away, no matter how exciting the growth story seems. The financial manifestation of a strong economic moat is crystal clear when you know where to look on a company's financial statements. A moat allows a business to sustain high returns on its invested capital over long periods. Return on invested capital, or ROIC, is a key metric. It measures how much profit a company generates for every dollar of capital that has been invested in the business. Think of it as the company's internal rate of return. In a perfectly competitive, moatless industry, competition will drive ROIC down to the company's cost of capital, meaning it creates no real value for shareholders. A company with a powerful moat, however, can consistently generate an ROIC of 15%, 20%, or even higher. It is digging a dollar out of the ground and turning it into $1.20 year after year after year. This is the financial signature of a great business. When you are analyzing a company, don't just look at its revenue growth. Look at its historical ROIC over the past 10 years. Is it consistently high and stable, or is it volatile and mediocre? A business with high, stable ROIC likely has a strong moat. A business with high growth but low or negative ROIC has no moat and is likely destroying shareholder value. This single metric is a crucial tool for any capital allocator, whether you're an investor choosing stocks or an entrepreneur deciding where to invest in your own business. It separates the true economic fortresses from the temporary high-growth facades. The ability to generate high returns on capital is what allows a company to self-fund its growth without constantly having to raise more money from shareholders. This leads to the magical effect of compounding, where profits are reinvested back into the business at high rates, creating a virtuous cycle of value creation. This is where real, generational wealth is built. It's not in chasing unprofitable growth, but in identifying and owning pieces of those rare, wonderful businesses protected by deep and widening economic moats. You can have the mindset of a business owner. You can find a company squarely within your circle of competence. You can even correctly identify that it has a wide and durable economic moat. But you can still have a terrible investment outcome if you make one final, critical error. You overpay. This brings us to the fourth pillar of the Buffett philosophy, the practical discipline that governs his actual buy and sell decisions, the margin of safety. This concept, which he learned directly from his mentor Benjamin Graham, is the single most important principle for preserving capital and ensuring high returns. The principle is simple. Price is what you pay. Value is what you get. You must never confuse the two. The value of a business is its intrinsic worth, based on its future earning power. The price is simply the quotation that the market is offering you on any given day. A margin of safety is achieved when you purchase the business for a price that is significantly below your conservative calculation of its intrinsic value. You are, in essence, buying $1 worth of business value for 50 cents. This gap, this margin, is your protection against the uncertainties of the future. The quintessential story of the margin of safety in action is Buffett's investment in the Washington Post Company in 1973. At the time, the market was in a deep slump. It was a period of high inflation and economic uncertainty, and investors were deeply pessimistic, especially about newspaper stocks. They were seen as old, dying businesses. The stock price of the Washington Post had been hammered. The entire company, which owned not just the famous newspaper, but also Newsweek magazine and several valuable television stations, had a total market capitalization of just $80 million. But Buffett, once again, did the work. He analyzed the Washington Post not as a hated stock, but as a collection of business assets. He knew the newspaper industry was within his circle of competence. He recognized that in a one-newspaper town, the dominant paper had a powerful local moat, a sort of monopoly on local advertising and news. He then set about calculating the intrinsic value of the company. He went piece by piece. He conservatively estimated that the television stations alone were worth more than the entire $80 million price tag. The newspaper, Newsweek, the real estate, all of that he was getting for free. In total, he calculated that the private market value of the Washington Post's assets was somewhere between $400 and $500 million. And yet, Mr. Market, in his infinite pessimism, was offering to sell him the entire enterprise for just $80 million. He was being offered a dollar bill for 20 cents. This was a massive margin of safety. He invested heavily, and over the next decade, that single investment grew more than 100-fold, becoming one of the cornerstones of Berkshire Hathaway's fortune. This story is the perfect embodiment of the principle. He bought a wonderful business with a strong moat that he understood well, at a price that offered an enormous buffer against being wrong. The psychological discipline required to demand a margin of safety is immense, because it forces you to stand apart from the crowd. The two biases you must conquer are anchoring bias and herding. Anchoring is our tendency to rely too heavily on the first piece of information offered when making decisions. In investing, the current stock price is a powerful anchor. If a stock has fallen from $100 to $50, people perceive it as cheap, anchored to the previous high. If it has risen from $20 to $50, they perceive it as, quote, expensive, anchored to the previous low. Buffett ignores these anchors. He calculates intrinsic value completely independently of the current or past price. His anchor is his own analysis, not the market's whims. This is why he could see the Washington Post as cheap at $80 million, even if it had been cheaper before. Herding, as we've discussed, is the instinct to follow the crowd. Demanding a margin of safety almost always means acting against the herd. You will be buying when others are panicking and selling, like with the Washington Post in 1973 or American Express in 1963. And, just as importantly, you will be sitting patiently in cash when others are euphoric and bidding prices up to the stratosphere, like during the dot-com bubble. The margin of safety is a psychological tool as much as it is a financial one. It is a pre-commitment to rationality. It's a rule that says I will not get caught up in the mania. I will not give in to the panic. I will only act when the numbers provide me with a significant cushion. This cushion protects you not only from errors in your own valuation, but also from the powerful emotional tides of the market. It is the discipline that allows you to be greedy when others are fearful, and fearful when others are greedy. It is the bedrock of low-risk, high-return investing. How can an individual investor put this powerful concept into practice? The key is to develop a systematic approach to valuation. A simple but effective mental model is what I call the two-valuation method. This process helps you establish a conservative range for a company's intrinsic value, creating the foundation for your margin of safety. First, you will calculate the liquidation value of the business. This is a very conservative, asset-based valuation. You look at the balance sheet and ask, if this company were to cease operations today, what would its assets be worth if they were sold off? You would value the cash at 100%, you would heavily discount the accounts receivable and inventory, and you would try to get a realistic market price for any property, plant, and equipment. This calculation gives you a hard floor for the company's value. It's the Ben Graham cigar butt valuation. For many modern, asset-light businesses, this value might be very low, but it's an important starting point. Second, you will calculate the earnings power value of the business. This is a valuation based on its ability to generate cash as a going concern. The simplest way to do this is to look at the company's average normalized earnings over the past several years, what Buffett calls owner earnings. Then you apply a reasonable multiple to those earnings. What is a reasonable multiple? For a stable, no-growth business, it might be 10x, which is like a 10% return. For a business with modest, predictable growth and a good moat, it might be 15x. You should be very conservative here. This earnings power value gives you an estimate of what the business is worth if it continues to operate as it has been. Now you have a range. You have the hard floor of the liquidation value and the more optimistic but still conservative earnings power value. The intrinsic value of the business lies somewhere in that range. The margin of safety principle then dictates that you should only be willing to buy when the market price is at a significant discount to the tile low end of your calculated range. A 30% discount is a good start. A 50% discount is even better. This is the engineering principle of investing, famously described by Ben Graham. You build a bridge to hold 30,000 pounds, but you only drive a 10,000-pound truck across it. That 20,000-pound difference is your margin of safety. It is the buffer that protects you if your valuation is a little too optimistic, or if the company hits an unexpected rough patch. It is what separates professional capital allocation from amateur speculation. The antithesis of this disciplined, value-based approach is a flaw that is endemic to investing in popular tech and growth stocks. It is the error of paying for perfection. When a company is growing rapidly and is surrounded by a positive narrative, investors tend to extrapolate that perfection far into the future. They build complex, discounted cash flow models that assume the company will continue to grow at 30% or 40% a year for a decade or more. They assume profit margins will expand and competition will never materialize. The stock price then rises to reflect this utopian future. The price is no longer just a valuation of the current business. It is a price that has already factored in a decade of flawless execution and uninterrupted dominance. There is no margin for error. There is no margin of safety. When you pay for perfection, any small deviation from the perfect script can lead to a catastrophic collapse in the stock price. If growth slows from 30% to 25%, the stock can get cut in half because the price was predicated on the fantasy of perpetual hyper-growth. If a new competitor emerges, if a product launch is delayed, if there's a change in regulation, any of these realities of the business world can shatter the illusion of perfection and evaporate shareholder wealth overnight. This is the story of countless high-flying stocks that once seemed invincible. Investors paid a price that left no room for reality. They bought at a price far above any reasonable calculation of current intrinsic value, betting entirely on a distant and uncertain future. The margin of safety protects you from this trap. It forces you to invest based on the durable reality of a business's present value, not on a speculative dream of its future. Any future growth you get is a bonus, a lagniappe, not the central pillar of your investment thesis. This is the difference between investing and hoping. The direct financial connection of the margin of safety principle is perhaps the most powerful of all. It directly and mathematically alters your risk and reward profile. When you buy a business at a 50% discount to its intrinsic value, you are setting yourself up for success in multiple ways. First, you dramatically limit your downside risk. If you are wrong about your valuation by 20% or even 30%, you still haven't lost any money. Your margin of safety acts as a capital preservation tool. As Buffett says, rule number 1, never lose money. Rule number 2, don't forget rule number 1. The margin of safety is the practical application of that rule. Second, it creates multiple ways for you to win. Your investment can be successful if the business's intrinsic value grows over time, but it can also be successful even if the business's value doesn't grow at all. Simply by the market repricing the stock from your 50% discount back up to its fair value, you can double your money. This reversion to the mean is a powerful source of returns that speculators who buy at or above fair value can never access. This dual engine of returns, from the growth of the business itself and from the closing of the price-value gap, is what leads to the extraordinary, low-risk returns that value investors seek. It is the ultimate form of portfolio strategy and risk management. It ensures that the odds are stacked heavily in your favor before you ever place a bet. By refusing to play unless you have this decisive edge, you transform investing from a game of chance into a disciplined and highly profitable enterprise. This is the final operational pillar of Buffett's genius, a wonderful business, understood, with a moat, bought at a price that offers a massive margin of safety. This brings us to our fifth and final pillar, which is not a part of Buffett's system but rather a deep examination of its polar opposite. We must fully deconstruct the mindset and the disastrous consequences of being an in-and-outer, the speculator that Buffett so often warns against. By understanding the psychology and the ruinous financial friction of this approach, the wisdom of the business owner mindset becomes undeniable. Buffett perfectly captured his disdain for this speculative activity in his famous parable of the Goatrocks family. He asks you to imagine a family, the Goatrocks, who are lucky enough to own every single publicly traded company in America. They own all the capital, and each year they receive all the profits generated by those businesses in the form of dividends. They get richer at a rate equal to the underlying productivity of American industry. Their wealth compounds beautifully over time. But then, a group of helpers shows up. These are the brokers, the market analysts, the fund managers. They convince members of the Goatrocks family to start trading their shares with one another. A Goatrocks who owns a piece of the railroad might be persuaded to sell it and buy a piece of the electric utility from his cousin. The helpers, of course, take a small commission on every transaction. As this activity intensifies, more helpers arrive. Financial advisors, performance consultants, and high-frequency traders, all encouraging the family to trade more and more, convinced they can outsmart their own relatives. The crucial point of the parable is this: the total wealth of the Goatrocks family as a whole does not increase because of this activity. They still own all of American business. The total pie is the same size. However, the family's collective wealth is now being steadily siphoned off by the friction costs, the commissions, the fees, the advisory charges paid to the helper class. The more they trade, the poorer they become relative to where they would have been if they had simply sat still and collected their share of the profits. This simple story is a devastating critique of the entire speculative industry. It frames hyperactive trading not as a sophisticated strategy, but as a loser's game, a self-inflicted wound on investor returns. The psychological drivers that push people into this self-defeating behavior are immensely powerful. The first is what's known as action bias. As human beings, we have a deep-seated instinct to do something, especially when we are faced with uncertainty or feel a lack of control. Sitting still feels passive, like we are failing to act. In the context of the stock market, when prices are volatile, the urge to buy or sell something, anything, can be overwhelming. Doing nothing feels like you're missing out or neglecting your duties. The financial media feeds this bias constantly, with its imperative to make your move or get in on the action. The in-and-outer is a victim of action bias, constantly churning their portfolio, believing that activity equals progress. The second related bias is the gambler's fallacy. This is the mistaken belief that if something happens more frequently than normal during a given period, it will happen less frequently in the future, or vice versa. In investing, this manifests as a belief in patterns that don't exist. A speculator might see a stock go down 3 days in a row and think, it's due for a win, and buy. Or, they might see a stock that has gone up a lot and think, what goes up must come down, and sell, ignoring the underlying business fundamentals. They are imposing a narrative of cosmic balance onto what is often a random walk of short-term price movements. They are engaged in a game of chance, not a process of business analysis. They are trying to guess the coin flips, a strategy that is doomed to fail over the long run, especially after the house, the helpers from the Gotrocks parable, takes its cut. The business owner mindset, with its focus on long-term fundamentals and its inherent patience, is the direct antidote to these destructive psychological urges. To protect yourself from these biases and avoid the path of the in and outer, you must adopt a practical system designed to encourage discipline and patience. This is the inactivity blueprint, a mental model focused on what not to do. First, you must change your information diet and your habits. Schedule your portfolio check-ins. You are not allowed to look at your brokerage account more than once a quarter. Daily or even weekly monitoring is a direct trigger for action bias. You see a stock is down 5% and your emotional brain takes over. By only checking quarterly, you smooth out the meaningless daily volatility and are forced to focus on the longer-term picture. Second, you must create a written investment policy statement. This is a personal constitution for your financial life. In it, you will write down your long-term goals, your defined circle of competence, your checklist for identifying a moat, and your strict rules for demanding a margin of safety. You will sign it. From now on, you are only allowed to make a transaction if it is in perfect alignment with this pre-written document. This act of pre-commitment ties your hands and prevents you from making impulsive, emotional decisions in the heat of a market rally or panic. Third, you must implement a 72-hour rule. If you read a news story or see a market event that gives you a powerful urge to buy or sell a particular stock, you are forbidden from acting on it for 3 days. This mandatory cooling-off period allows the initial surge of adrenaline or fear to subside. It gives your rational brain, your prefrontal cortex, time to come back online and reevaluate the situation calmly and objectively. Almost always, after 72 hours, the urge will have passed, and you'll realize that the news was not as world-changing as it first appeared. Finally, you must change your primary metric for success. Stop focusing on the daily price of your stocks. Instead, create a simple spreadsheet that tracks the underlying earning power of your portfolio. For each company you own, track its earnings per share. Your goal is not to see the stock prices go up every quarter. Your goal is to see the earning power of your collection of businesses steadily increase over time. If the businesses are becoming more profitable, the stock prices will eventually follow. This shifts your focus from the manic Mr. Market to the performance of the actual enterprises you own, which is the only thing that truly matters. The antithesis of this calm, disciplined approach is the entire ecosystem of speculation that dominates modern financial culture. This whole pillar has been about deconstructing that antithesis. But it's worth focusing for a moment on the tools and behaviors of the speculator, the 99%. They are obsessed with things that have no bearing on intrinsic value. They engage in technical analysis, which is the practice of reading stock charts as if they were tea leaves, looking for patterns like head and shoulders or death crosses. It is a pseudoscience that provides an illusion of control and predictability over the fundamentally unpredictable short term. They are day traders, sitting in front of multiple screens, trying to scalp pennies of profit from meaningless noise, a high-stress, high-cost activity where the vast majority of participants lose money. Their entire worldview is shaped by the financial media entertainment complex, which has a vested interest in promoting action and drama. A headline that says billionaire investor sits patiently for a decade doesn't get clicks. A headline that screams Dow plunges 500 points on fear, what you should do now, gets millions of views. The very structure of financial news encourages the in and outer mindset. The most recent and extreme manifestation of this speculative pathology was the meme stock craze. Hordes of retail investors, organized on social media, piled into fundamentally broken businesses, not because they believed in their long-term prospects, but as part of a collective, nihilistic game to squeeze hedge funds. The stock price became completely detached from any semblance of reality. It was pure, unadulterated speculation. A mass psychological event that, for most who participated late, ended in financial ruin. It is the goat rocks parable playing out in hyperspeed, a frenzy of activity that ultimately enriches the helpers, the trading platforms and market makers, at the expense of the participants. The direct financial cost of being an in and outer is not just theoretical, it is a quantifiable, multi-trillion-dollar drag on investor wealth. Let's break down the sources of this massive friction. First, as we've touched upon, are taxes. The difference between short-term and long-term capital gains tax rates is a massive hurdle that active traders must overcome just to break even with a buy-and-hold investor. Over an investing lifetime, this tax drag can consume a shockingly large portion of your potential returns, making the journey to financial freedom significantly longer and harder. Second are the direct trading costs. While commissions have come down, they are not zero, and the bid-ask spread is a perpetual tax on every single transaction. For a hyperactive trader, these small cuts add up to a death by 1,000 paper cuts, bleeding the portfolio dry over time. But the most devastating cost, by far, is behavioral. It is the cost of consistently mistiming the market. The data is unequivocal on this point. Study after study, most famously Dalbar's annual quantitative analysis of investor behavior, has shown that the average investor's returns are far, far lower than the returns of the market indexes themselves. Over the last 20 years, while the S&P 500 might have returned an average of 9 or 10% per year, the average equity investor has often earned less than half of that. This enormous gap is not due to bad stocks or bad funds. It is purely the result of bad behavior. It is the financial cost of panic selling during a crash and FOMO buying at the peak of a bubble. It is the price paid for being an in and outer. By adopting the 5 pillars of the business owner mindset, thinking like an owner, staying in your circle, demanding a moat, insisting on a margin of safety, and committing to inactivity, you are not just embracing a quaint philosophy. You are opting out of this wealth-destroying machine. You are stepping off the emotional roller coaster and onto the steady upward escalator of long-term compounding. You are choosing the path of the 1%, not through luck or genius, but through discipline, patience, and a superior psychological framework. This is the real reason Warren Buffett has succeeded, and it has nothing to do with being a dinosaur. It has everything to do with being a business owner. You have just invested a significant amount of your most valuable asset, your time, into rewiring the very foundation of how you think about money and markets. You have moved beyond the noise and the speculation, and you have acquired the complete mental toolkit of a true capital allocator. You now possess the business owner mindset, the discipline of the circle of competence, the analytical framework of the economic moat, the practical defense of the margin of safety, and a deep understanding of the psychological traps that ensnare the vast majority of investors. This is not just a collection of tips, it is a comprehensive operating system for building real, durable wealth and achieving financial freedom. But you must understand that what you have just learned, as powerful as it is a single, perfectly crafted key. Warren Buffett's system is not a set of isolated principles. It is an interconnected network of mental models, a lattice work of wisdom where each idea strengthens the others. Mastering this one key has unlocked a crucial door, but the castle it leads to has many rooms, each containing another piece of the map to total financial mastery. The principles of capital allocation, of assessing management, of understanding market psychology, they are all connected. And right now, on your screen is the next piece of that map. The algorithm has analyzed your commitment to this deep learning and has selected another node in this web of knowledge. That video is not a random suggestion. It is the link that connects what you have just mastered to the next level of your ascent. It is the missing piece that will take this foundational knowledge and multiply its power. The choice is not whether to watch another video. The choice is whether you are the kind of person who starts a journey and sees it through to the end. It is a choice about your identity. Are you a dabbler, content with a single insight? Or are you a true student of the game, committed to assembling the entire mental arsenal required to win? Complete your training, strengthen your mind, click, and continue your journey.